Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and today we are running through the December 2024 market update, Australian property market update. Final one for the year. Strap yourselves in. There's plenty of data in this one, and we'll run through some CoreLogic data, and I'll give you a forecast based off the 18-year land cycle. So to kick it off, this is the CoreLogic dwelling price month on month index. We've had a retraction 0.1% slowdown for the month. So before you may be thinking, oh, are we starting a bear market? Don't get too paranoid. In the similar point of the cycle, say in 2004, 2005, there was a retracement followed by a significant then bull run up until the peak of the market come, say, 2007, and then the GFC, which is the land-driven downturn. So we've had minor pullback, but that has mainly been the result of the softening of growth from Perth, Adelaide, and Brisbane, be it their growth is still very strong, and the softening in Melbourne and Sydney. Also, the slowdown in regional Victoria and pretty modest to subdued growth in regional New South Wales. The respective regions to Perth, Adelaide, and Brisbane are still going strong. So the leading markets for immediate growth is Perth, Adelaide, and Brisbane continue to be the strong markets, and the softer markets are Melbourne and Sydney, but they'll have future growth as they are yet to commence their next growth cycle. And Victoria and the regional Victoria, regional New South Wales are starting their protracted soft period, and the regions out of WA, South Australia, and Queensland continue to keep going strong. So there has been a rise in listings out of spring and since the end of winter. So this is pretty much seasonally expected as people list their properties on the market in spring and coming into Christmas. We have had a rise in listings, so this has resulted in softer clearance rates. But then also, if we look at the last 5-year average, we are still in very strong position in terms of the total amount of listings over the last, compared to 5 years ago, or 5-year average, less than 20% available in Brizzy, less than 31% still available in Adelaide, less than 30% still available in Perth, hence why all the stock has been soaked up and prices continue to keep booming as there's less supply and a lot of demand from investment looking to go into those markets, as those markets are well and truly in FOMO. And 10% higher listings relative to the last 5-year average. So 10% higher in Sydney and 9% higher in Melbourne. So based off the 18-year land cycle, we are now entering a similar point of the cycle in 2005, a couple of years prior to the GFC, or a couple of years away from the peak of the market in 2026 before we go through the next land-driven downturn, which is due to commence around 2027. So we use this framework, as you are well aware, as one of our key fundamentals in selecting each market, as I'll show you in these future slides of how each market is performing based off the cycle, based off where we're heading in the coming years will be equivalent to 2005, 6, 7, and 8. So keep that in mind when looking at these graphs coming to you soon. We are in a point of the cycle such as 2005. So Brisbane, Perth, Adelaide are going gangbusters, but they're not necessarily the markets we are buying in. A lot of the mainstream and FOMO is rushing in there now, but we are now only focusing on Sydney and Melbourne for the next couple of years. Perth, so this is units for Perth. We like to buy units in the metro markets rather than houses. If you buy a house in the metro market, yes, you'll get growth, but you'll sacrifice on your yield. So for the price of buying $1 million plus house, you could buy 2 or 3 or 4. Sorry, for the price of buying $1 million plus house, you could buy 2 or 3 or 4 units with high yields, and we buy units with yields of minimum sort of 6 to even 7%. So that's why we like to focus on units, established units, not high rise, off the plan stuff, but established units in the metros, strong yield, half the intrinsic value, but buying them at the right time of the cycle and not during a heated bull run. We like to get into markets prior to their bull run. So as you can see, we're now here. This is Perth for units in a specific suburb that we like to keep tabs on. So as you can see, the last couple of years from 2020, it's been going gangbusters. Similar point of the cycle, 2005. So look what happened back in 2005, 6, 7. It also went gangbusters until it switched off and went through this up and down band for many years and retraced a fair bit until it bottomed out around 2020 before it commenced its current growth cycle. So that's where Perth is at. That's also reflective in CoreLogic data. As you just saw before, Perth continues to keep going gangbusters and is well and truly in FOMO. Every man his dog is talking up Perth these days. Every investor is looking to buy in Perth because everyone gets sucked into the herd when markets go gangbusters. But we don't. We don't like buying in markets that are overheated because you overpay and then you end up buying it in an overheated market and hold it through a protracted long period of stagnant to negative growth. So we don't advise doing it. This is Perth. Next one is Adelaide. Same again. Adelaide's pretty much off the charts. For units wise, it has a few more years to run, but it's pretty much getting to a stage where it's about to hit its limits and then start its next protracted growth run. As I said, we are in a similar point of the cycle in 2005. And as you can see in 2005 to 2008, had still some growth, but then it leveled out over a good solid 10 years. So when you see markets starting to go vertical like this, it is definitely not a good sign to continue to buy in those markets. That's Adelaide. This is Brisbane. Same story. Brisbane's going very strong and it will continue to go strong over the next couple of years until it'll top out around 27, 28 and then start its protracted flat period. We were buying a lot up in Brisbane between 2018, 19, all the way to about 2023. Come 2023, it was becoming too hot for my liking, and we decided to take our money and invest elsewhere. So that is Brisbane. As you can see, it's going gangbusters and will continue to have solid growth over the next couple of years. But it is not a market we are looking to keep buying into for units. Regional Queensland, so houses, we like to buy houses in the regions as you can get a large lot of land. You can still get them with strong yields of 6, 7, even 8% before they hook into their growth cycle. And then they have a solid parcel of land that you have development upside. This could be either a modest granny flat, a subdivision, or you may even want to knock it down the track to build a block of 3 or 4 units once it stacks up. Not straight away. Typically, we buy assets, let them cash flow for 5 to 10 years. In the meantime, get them DA approved and then look to either develop once the market moves or even offload with a DA approved site. So houses in the regions we target. And as you can see, regional Queensland has been on a strong run the last couple of years since the commencement out of 2020. And it is not reaching its limits yet, but it is starting to slow, as you can see. And between 2005, 6, 7, still had growth, but not as strong as the last couple of years. And then it'll level out and then go flat to subdued backwards for 10 plus years. So Queensland is another market we are no longer buying in, but even though it will still have a few more couple of years of growth ahead. Regional New South Wales, as you can see, regional New South Wales has topped out and has commenced its softening. It's starting to cool the last 2 years or so, and it will continue to cool and go subdued for a solid over 10 plus years. So another 10, 11, 12 years before it'll then commence its growth cycle in the later stage of the next 18-year land cycle. So regional New South Wales is definitely not a market we're looking to buy in, and even personally looking to sell a couple of assets out of regional New South Wales this year potentially to then reinvest down into a different market. So regional Victoria, similar story, has topped out and has began its retracement. 2 years in or so into the retracement, it will continue to soften out. Won't go through as long as a protracted slowdown as most of the large regional Victorian hubs are close to Melbourne and not as far out in the regions. So, but we are expecting regional Victoria to continue to soften over the next couple of years before it will then commence its growth cycle in probably 7 to 8 years' time. Sydney has had a bit of a kick this last 2 years, but I'm expecting it to soften come 2025, 2026, and well, the next 2 years, and then come say 2027, it'll then be commencing its next growth cycle as what it did from 2007-8 all the way up to 2017. So we are getting very excited of Sydney. We have been buying in Sydney provided we get the right price. We like buying in Sydney for sub 350 grand for units. As you can see, this suburb is as a medium of 500,000. So it is tricky to get a good deal in Sydney currently, but I'm expecting Sydney to soften over the next year or two where the deals will be popping more so, but they are still, you can still get a good deal in Sydney for sub 350. We don't like overpaying, obviously, more than 400 for a unit, so ideally sub 350 for units in Sydney. But it is a market we are buying. Melbourne, we are super excited of Melbourne. It has flattened out and will continue to flatten out for another year or two, but pretty much it is bottomed out and is any year now, a year or two away, as history doesn't repeat, but it definitely rhymes, from commencing its next growth cycle. So Melbourne, I believe, is ahead of Sydney by probably 6 months before it commences its next growth cycle. So that's why we are super pumped and buying deals every day of the week down in Melbourne for sub 300. So this is a bit of an update for this slide. This is the property cycle as I see it for each sub-market. As I said, and as you probably already know, Perth is well and truly going gangbusters in FOMO, along with Adelaide, Brisbane, and regional Queensland. But over the next, say, 2 to 3 years, they'll reach their limits and then start to cool, like what New South Wales, regional New South Wales, and regional Victoria are doing so now. They've already reached their limits and they're starting about 2 years into their cooling market. And then we've got Sydney, that's probably 2 years away from the bottom, and Melbourne probably a year away from the bottom. So we like to buy between this low competition, low bottom market, rising rents, as that is the last couple of years of a 10-year retracement or stagnant period prior to it going through its growth cycle. And then once it goes through the growth cycle, as we own property in these markets, we like to then add value by renovation and development rather than continue to keep buying in these markets and overpay like what most people like to do. We add value by sweat equity, renovations, and development to add more stock into those markets to capitalize on the growth, but not continue to keep buying in the overheated markets. And then once we see a good 7-8 years of softening, cooled market, that's when we like to enter the markets in when it's low competition, bottom market before rents rise. And then once what rents rise, but before prices start to rise. And you may be thinking, well, is that too early to get into those markets? No, because we get great deals. We get deals anywhere between 30 to 80,000 less than bank value. So you can strip your equity out right away to put into the next deal and keep plowing in to the soft markets like sowing seeds does, like a farmer sows his seeds in soft markets and then harvests his crops in hot overheated markets. We do the same. We buy in soft and suppressed markets, we hold them through their growth cycle and then look to refinance or harvest and completely sell out of these overheated markets to then reinvest the capital into more suppressed markets to invest counter-cyclically. So buyers beware, there's plenty of sprinkers out there these days as we come through the heat and that are pushing products such as new and off the plan and blue chip stuff, but we don't push that. We look to buy property that cash flows before they go through their growth cycle that also have development upside. If this information resonates with you, hit us up. Happy to chat about your plans for 2025 year ahead. As always, this is by no means any financial advice, as I am not a financial advisor and I do not know your personal circumstances. However, I operate as a buyer's agent. If you are interested in buying an investment grade property and capitalizing on the future growth cycles in the years to come, hit me up, send me an email. Happy to chat about your plans and see where we may be able to help you on your investment journey. Enjoy the rest of your holidays. Take care.